Thanks for downloading this episode of the Resilient Advisor Podcast. My name is Jay Coulter, and today we're going to talk about artificial intelligence and its impact on the investment management and financial advisory business. Joining me is Kyle Wiggs, who's a managing partner at Exact Strategies, a firm that focuses on advanced technologies for financial advisors, asset managers, and financial institutions. Kyle, thanks for coming on.
Absolutely, Jay. Thanks for having me.
All right, this is a hot topic right now. Let's dig right in. Could you tell us what artificial intelligence means for the purposes of our conversation as it relates to our industry?
Absolutely, yeah. It's a great question and an important one. You know, Jay, there's a lot of discussion about artificial intelligence as a whole, right? It's become increasingly in vogue. And I think what we have found is most people think of AI, as we refer to it, as something similar to like IBM's Watson or some of the robots or machines that we see on television that constantly learn from themselves and then make better and better decisions. And that's certainly one form of it. But for the purpose of our discussion and conversation, I actually looked up the actual definition of artificial intelligence as presented by dictionary.com, which is it's the theory and development of computer systems that are able to perform tasks that normally require human intelligence. So if we think of some examples, things like visual perception or speech recognition or the ability to translate languages. And lastly, and I think the most important one for the purpose of our discussion is decision making. How can we use these computer systems to perform tasks that normally an advisor or perhaps a financial institution would make to make better decisions for the clients we serve?
So, moving away from any dogma related to what Hollywood shows us about the future of artificial intelligence and taking over the planet, and really more into real-world application, right?
Right, exactly.
All right, so then, given that lens, why are financial advisors slow to adopt AI when it comes to making investment decisions or even managing their business?
So we talk to advisors every day, and there's obviously a wide range of reasons. Really, I would say number one is that the stakes are so high in the business of, being a financial advisor or an institution, right? We're talking about dealing with, the wealth, the protection and growth of families' money, and that's a huge responsibility. And with so much at stake, we have found that most people, they tend to stick with what's comfortable and are afraid to really take risks, right? They're afraid to step outside of the box. That's the first reason. The second reason is there's not necessarily the incentive to change. So if we think about our industry, right, most of the incentives are tied to a benchmark. So if we think about the third-party manager that we may hire, or if we choose a fund or an ETF, if the incentive is to track or to outpace a benchmark, that's really sort of the goal that we've established. If we think and apply that back to 2008, right? If I didn't lose as much money, but I ultimately lost 20% of my client's wealth, I may have received a bonus. And so we view that as really a broken system. And until we change somewhat how incentives are paid out and agree to what the goals are, we think that the adoption rate will continue to be a little bit slower.
So I've been in this industry for almost 20 years now, and advisors being afraid of change and not doing anything without incentives has not changed at all. Clearly, that is going to change with the adoption of AI technologies and what's coming. For any advisors listening that are apprehensive about it, I highly recommend Ray Dalio's new book called Principles. In the book, he lays out his experience in the industry and how they were early adopters at Bridgewater of taking what we now call AI, but applying it to their business. And back then, it was very simplistic and basic and involved with time, but it fundamentally changed their business and the outcomes they were able to deliver, which you can see in the results, having the largest hedge fund in the world. So thinking about today's advisors, Kyle, and the current markets, where is that AI going to have an impact today and going forward?
So it's having an impact, in a multitude of different ways. When we think about, as you laid out, AI is almost becoming this flywheel concept with more people that understand it and are less afraid of it, more momentum is certainly created with it. And so as we look at the landscape today, what's great about artificial intelligence is that, Jay, it's not tied to the past and it's not concerned about the future, right? Its only objective is to create an awareness around the present. And so as we think about this year as a standalone example, the biggest impact is really in the decision-making process around where to find investment income. Every advisor we talk to day in and day out, that seems to be their biggest challenge is where do I go to find income sources that I've been using or relied upon for the last 10 or 15 years, right? And so many portfolio managers and advisors have been positioning portfolios for the possibility of rising rates for several years now. And ultimately, most of those advisors and clients have kind of sat and waited in anticipation for rates to go. And we've talked about this year in and year out. And now it's actually happening, right? And so now advisors that we speak with, they're engaged with clients having to explain, why is this portfolio that I've had for so long now all of a sudden negative with, the ag down around 2% for the year? And so I'm not sure if you've seen the study, but it's a great one to read for all advisors out there. It was done by PIMCO alongside in partnership with Research Affiliates. And they came out with their 10-year forecast. And I thought it was fascinating as I read through it. And everyone's got a forecast, but the outlook specifically honed in on a traditional 60-40 portfolio. And essentially the punchline or the conclusion, it's their estimation that a traditional 60-40 is going to yield 0.5% on average for the next decade after inflation. And so I think we should ask the question, what advisor or what client, if we were to sit here 10 years from now, looking back on the past decade, would ask themselves, 0.5% real return is something that I would define as successful. And we just don't think that that's going to make the grade. We think clients and advisors have substantially higher expectations. And so what artificial intelligence brings to the table in this environment is that decision-making capability without any biases. And those biases aren't defined by the past. And so all it cares about is where is the most productive source of income today. We don't care about tomorrow. We're only concerned with today. And so if you think about an analogy, Jay, think about how we navigate kind of our daily lives, right? So if you think of Google Maps, if we were to open it right now and I were to drop in your address, it would tell me exactly how long it would take to get to your office, and it would ultimately tell me what the best route is based on current conditions. And so if we think about this idea of allocating capital based on what's happened in the past, that's kind of like Google Maps saying, I'm not going to get on the highway to come see Jay because there was an accident there yesterday. And so what AI is bringing to the marketplace today is that capability to find where's the most current productive source of income, regardless of what interest rates are doing.
So you think today that's where AI has the most impactful opportunity set, is helping identify income streams?
Absolutely. So when we talk to advisors that have heard about artificial intelligence and specifically about exact strategies, the first question that we often ask is, what's the biggest challenge you're having in your business today in terms of portfolio construction? And to a person, it's, I'm having a really hard time with my income allocations, whether that's a part of a portfolio or the whole thing. And so this concept of artificial intelligence is to literally put a blindfold on and say, listen, we don't care what's gone on in the past. We are going to measure current real-time information, we being the computer systems, to identify the most appropriate place to be today going forward.
Okay. Do you, based on your experience in the space, do you see any other major trends within the advisor community where AI is going to have a positive impact that listeners might not be thinking of right now?
Yeah, absolutely. That's a great question. So one of the things that we see a lot of, there's a number of studies that have been done about the shift out of active investments and into passive, right? You've read the studies, and really it happened as a result of primarily 2008. So since 2008, we've seen this huge shift. And so as we move away from active and into passive, we talk about it. I read articles and we talk about it as if it's a zero-sum game, right? Where one is always better than the other. And if you talk to an advisor that loves passive, they'll tell you all the reasons why active shouldn't be used, and vice versa. And so when we read publications like the SPIVA report, It's true that the majority of active managers, right, they do underperform net of fees over long cycles. Mm-hmm. But that's measuring, as we all know, from a very defined starting and ending point. Life and the markets are so much more fluid than a starting and an ending point. And so if we peel back those stats, which we've done, and you start to look at sort of different pockets of time, there's no doubt that it's very difficult over 10, 15, and 20 years for those managers to add value net of fees over the index or the passive vehicle options. But if you isolate 60, 90, 120-day pockets, you can find tremendous value from some of these actively managed funds. And so the beauty of AI, to answer your question, is what it has the capability to do is to really not force an advisor to choose one or the other. It has the ability to force active and passive to simply compete against each other, and it will pick up on the differences in price movements to identify when it makes more sense to own active and when it makes more sense to own passive. And as you highlighted in one of your earlier podcasts, speaking about the first half of 2018, this has really been an environment as more and more people pile money into ETFs, into passive ETFs specifically, where active managers have added tremendous value, right? So, for example, Jay, we've got clients who utilize artificial intelligence, but they only apply it to passive vehicles. And then we have others who say, I don't want to do that. I want to actually utilize it to its capability to force active and passive to compete. The portfolios, a growth portfolio that's all passive is up roughly 6% year to date, whereas those that use both are up 12 to 14 through the end of June. And that's all while maintaining the same risk profile. So that, to us, is the power of artificial intelligence.
All right, let's go a little bit deeper on that and talk about exactly how Exact Strategies is leveraging AI to execute on what you just laid out.
So when we talk to a lot of the advisors, it's nearly impossible, right, for advisors to perform complete due diligence on every mutual fund, on every ETF, and on every TPAM available to them. It's just there's not enough hours in the day. And so when we think about that question, we could talk, ultimately a couple different podcasts on the full capabilities of what it has the ability to do. But if we focus on two, really, AI has expanded the investment options available to the advisor because simply the technology can perform due diligence on a real-time basis on an unlimited number of securities. And that's something that an advisor just simply can't do. The second thing is that AI has the ability to support advisors regardless of their business model. So whether you're at a broker-dealer and thinking about an RIA or whether you're at an RIA, artificial intelligence literally says, okay, Jay, what is the entire universe of approved securities that you want us to look at? Don't narrow your focus to maybe the one or two relationships you have. Let's expand that in the interest of your clients. And so we take that and we match it up with a client's risk profile and goal. And the artificial intelligence, the technology can so quickly and accurately recommend where to be invested based on the current market conditions. And ultimately, it creates an optimal portfolio for a client with a better outcome.
So the client ends up with a better outcome in their portfolio because of the technology's ability to execute on a set of rules based upon the client's risk profile. Is that correct?
Absolutely.
So it's taking you and I both. So it's taking a highly active stance in the portfolio.
Absolutely.
Okay. So how does that work when you're dealing with money in taxable accounts? Do you find advisors still leveraging the technology?
So we see advisors that sit on both sides of the fence. They're, especially earlier on in the relationship, it's a little bit, if you're right-handed, like learning to throw with the left hand, because for so long we've adopted relatively similar principles to modern portfolio theory, and we build an asset allocation and we sort of set it, rebalance it once a year. And so for those advisors, they tend to stick or utilize the technology and stick with qualified dollars. Where we find advisors embracing it on both qualified and non-qualified is as they've gone through multiple cycles and found its ability to identify where is the appropriate place to allocate capital today. It really does a nice job and helps preserve, wealth for the clients that they serve. And so as they do that, they think that's a fair trade and concession for obviously the ability to have to pay ordinary income on capital gains.
Got it. Well, I can tell you, listeners, I've gone through a demo of the technology. It's pretty cool. And I highly recommend, if you're considering implementing AI into your practice, at least taking a look at what Exact Strategies can do. Kyle, tell us, where do you guys see this technology evolving over the next couple of years?
So where we sit today is we have a little bit of a different approach in terms of how we'd like to grow. We're very selective and thoughtful about who we want to partner with. We're really strategically targeting 500 of the premier advisors across the country, the advisors who embrace technology, who understand the impact that artificial intelligence can have on their business, and who ultimately share our common goal to give clients the best possible outcomes. And so they're looking for tools to help them grow, right? And the second thing is that we've been approached by 3 or 4 different annuity companies and ETF manufacturers to say, hey, we'd like for you to help us help our advisors with the sub-accounts that we provide inside of our annuity lineup. And with respect to, there's so many different ETF manufacturers coming to market, that's a hard space to crack. And so if you think about the dominant players in that space, they've really got somewhat of a stranglehold on the market share. Where we see our technology evolving is twofold with the ETF side. One is, how do we tactically allocate ETFs in a way that makes sense, that is accurate, scalable, and repeatable? So we're working with a couple of different ETF manufacturers today to help them go to market with some solutions utilizing the technology. And then lastly, what we see coming as an offshoot of that, tying into your earlier question around taxes, is we ultimately see this having the ability to create artificial intelligence empowered ETFs that an advisor could allocate inside of a non-qualified account and not worry about the tax consequences associated with some of the moves that are made within the portfolio.
Great. Well, Kyle, you and Exact Strategies are in a very exciting corner of our industry right now, especially as you look out over the next 12 to 24 months. I appreciate you coming on and sharing about what you guys are doing. How could listeners find out more about your firm?
The best way to do it would be to go to exactstrategies.com. They can go there, read more about the technology, and schedule a demo if they think it would be a good fit for their business.
Awesome. Kyle, thank you so much for coming on.
Absolutely, Jay. Thanks for having me.